Let's plot the price chart for 3 Singapore banks. DBS close to 50% gain. UOB and OCBC 30+% gain. Today, I'll be answering this question. Should you continue buying them or not? I'll answer them based on a few parts. The first being an explanation. Why has the share price risen so strongly over the last 1 year? The second part, I'll be sharing with you the risk reward on how I interpret things. Maybe you can see whether you agree with them or not. But as always, this is not a buy or sell recommendation. And last but not least, I'll show you solutions. Especially if you are looking to be a dividend investor. You're looking at all the other blue chip companies and they haven't done as well as banks. So where else better to invest for dividends? So if you're keen to find out, continue watching. Hi guys, welcome back. Without further ado, let me show you something shocking, which is actually this. That Singapore Bank's share price performance is not unique. Actually, if you compare DBS, which is our biggest Singapore bank, against the biggest China bank, ICBC, against Bank of America, which is the second biggest US bank, the first being JP Morgan, and of course, Australia's biggest bank, Commonwealth Bank of Australia, you would realize that everybody has shown fantastic 1 year performance, correct? So it's not only that our banks are so special, but across, it's a tailwind for all banks in general. So if you see the price chart, you would realize that they've all trended up roughly the same. But I've pointed out a few special parts. In April, there was a big down leg affecting all banks. In September, there was also a big down leg affecting all banks. But as of October, there was a big leg up, correct? Especially for the biggest banks of these various countries. But before we get further, let me share with you something more interesting to help you understand investing into banks a bit better. In Singapore, all 3 banks have done really well. But I did not observe that across banks in other countries. If we look down under in Australia, you would realize the Commonwealth Bank of Australia outperformed massively Westpac Bank and ANZ Bank. Investing in these 2 banks will have yielded relatively much less over the last 5 years. What about for US? You will realize that Goldman Sachs performed more than 130% over the last 5 years. JP Morgan, also very strong returns. Wells Fargo, 30+% over the last 5 years. But for Wells Fargo and Bank of America, not so good. Because again, this is a 5-year performance. And worst of all, Citigroup, they have declined over the last 5 years. So as I mentioned, this is a tailwind. It seems that banks in other countries do not demonstrate a coherent leg up together. Maybe the understanding is Singapore banks, all 3 of them have a lot of lending in Singapore itself. And Singapore economy is relatively strong and stable. That is why they've trended roughly the same. Maybe that cannot be said in Australia and in US. But that also means one thing. When you invest in Singapore banks, there is a concentration risk in Singapore economy. There is no guarantee that 20 years later, it will be the same. So don't invest blindly and hope that things will never change. Actually, in the investing world, things always change. So keep tabs on the market and always understand why you've invested and know how to evaluate the value of a company. But at this point, I want to go back again to our 3 big arrows just now that I mentioned, which is a decline in August, a decline in September, and then a leg up from October. Let's use DBS chart to show you the reason of things. In August, there was a yen carry trade, correct? That crashed, pulling almost all stocks with it, banks included. So with this is a quick reminder that when there's a recession, bank shares will also come down. It's not true that banks will never come down by 20%, 30%. If you look across history, which I'll show you later, you would realize that these things are bound to happen. Again, it's not saying that banks are lousy companies to own. In fact, the Singapore banks have all done very, very well. Then again in September, a decline because Fed did a 50 basis point rate cut. The first ever in a very long while, and that was above market expectation. Banks of course make money through net interest margin, which is their biggest pie of revenue. And when Fed cuts rates, the projected future returns will start to decline. And that's why bank shares corrected down. If Fed cuts rates, again with a recession for example, interest income will shrink, bad debts provision will increase, loans will start to shrink. So it's a typical triple whammy to banks, and that explains why banks are cyclical. If we look in the last 5 years, of course we think that it'll never come down. But again, I try to show you through history so you become better prepared. But today I prepared this presentation to show you something that I've recently learned as I read a bit more. Some possible tailwinds to banks. So before we get there, smash the like button, smash the subscribe. Especially appreciate this sharing. I'm filming this on a Sunday, taking my own personal family time. So thank you very much for the support. And with that, let's unveil that the reason banks had a new leg up against all expectations, or at least mine, because it's true, I've done previous videos saying that I will not buy bank shares. Again, not saying to sell bank shares. That's a two different message totally. But what I realized is that since October, half of the rally can actually be attributed, looking back now, on Trump's victory. Very weird, correct? I never expected that. And I know Trump is going to come into office as of January 2025, and he won the election in November. But actually in October, there were already polls suggesting that he would win, and markets again is looking forward. It's easy to explain now on hindsight because there is expectation that with Trump's victory, there is possibly less stringent regimental regime on Wall Street. This means less compliance costs, less headcount, etc., which will boost banks' profitability. In a simple statement, banks are also expected to benefit from potential tax cuts. Do note to this point, our 3 local banks will be subjected to higher tax rates with regulatory changes from 2025 onwards. That's something I've covered before in my bank videos. Let's dive back to a very, very important price chart, which is this. I've painstakingly dug this up and labeled it to show you very cleanly what to expect, because I want to answer the question, correct? What is the risk reward? That indirectly answers the question, should you buy bank stocks aggressively right now? For the last 1 year, DBS has performed 50%. Warren Buffett is just saying, on a long-term average, corporates only grow profitability by 7%, which means if share price appreciates 20% a year for a while, eventually the price will be high relative to earnings and they'll be risky. 50% is no joke. That is not sustainable for any stocks. Come to here, I'd like to ask a question. In the last 20 years, how many times has DBS stock rallied 50% over a year? Take a quick guess. The answer? Only 1 year. Calendar year 2009. That was an 83% gain, correct? As I've labeled over there. And that was coming from a market crash. It was like a rebound. And the situation is very different to now. So if you look in terms of a 20-year time frame, DBS share price has never performed 50% over a year. And when we realize this, it certainly seems scary, correct? This is an unprecedented gain. Can it be sustained or not? Or are investors overpaying for it right now? Think through the question, and as always, leave in the comment sections. Let's be constructive. And I'll next move on to explain to you certain bull legs that DBS has seen in terms of share price. And they will be in 2006, where it gained 36%. 2017, where it gained 35%, and in 2021, where it gained 30%. So if you're ready, let me flash up a next chart, which explains why these big double-digit bullets came about. On the top, I've plotted DBS share price, and on the bottom, I've plotted Fed interest rate cycles. What do you realize? I've connected arrows, correct, on DBS share price gain against Fed rate hike cycles. 2006, 2017 and 2021. The correlation is very obvious, correct? When Fed has a rate hike cycle, it swells the net interest income of banks. Understanding this gives you a lot of clarity what the tailwinds are for a bank. Yes, it is true that our 3 local banks are building some diversification to their arms. They've all wealth management arm. Singapore having a lot of family offices opening up is also a good tailwind. But banks again make the most through net interest margin. And when you understand this tailwind, you will understand that this tailwind is not permanent. Now let's draw our attention to the red zone I've circled over there, 2010 to 2015. That is a period where Fed has kept interest rate at close to 0%, correct? What has happened if we zoom into that portion? You realize that DBS share price has stayed relatively flat. If we plot the previous peak in 2007, where investors bought back then at $20+, for the next 10 years, DBS share price did nothing. Interest rates being low was a headwind to growth of profitability. Very weird, correct? Very different from what we see right now. So history teaches us what to anticipate moving forward because the future is always unknown. We are trying to make the best guess of what we know to make an evaluation of risk reward. In fact, it was so severe that if we plot DBS against STI index, you would see another story coming through. Blue shaded area is STI index. Red line is DBS Bank. If you ask anybody on the street right now, they'll say buy banks, don't buy STI. I've seen that myself in forums. In fact, I've also kind of mentioned it inadvertently until I studied this graph. I didn't realize also that STI outperformed DBS from 2004 to 2007. And the reason is quite clearly there were developers like CapitaLand, like City Development, that was rising fast in share price and they constituted part of the index. The index continued to outperform banks all the way until 2013. Unbelievable, correct? But because banks are such a major weight in the index itself, if banks don't grow, the index is stuck. That is the reason why STI has been flat. You understand it now? It's because banks were flat. That's why STI didn't fly like S&P 500. Now the reverse is happening. Banks are pulling up STI index. That's why Straits Times Index is the best performing Southeast Asia index due to its 3 banks. You understand it already now, correct? Banks only finally outperformed in 2017, which as I mentioned just now was when Fed rates started to go up. That outperformance has lasted until now, which is 8 years plus and counting, because I thought of a new scenario that has not yet been mentioned before that could happen or could explain why markets are bringing up bank stocks. Could there be a remote possibility that instead of Fed cutting rates all the way down, Fed instead increase interest rates somewhere down 1 year where inflation has roared back again? A very unthinkable situation, correct? But as I studied back in the dot-com bubble crash, there was a period where Fed cut rates back in January 1999. Then subsequently, they raised back rates after a year later. You know, we mentioned so many times, could this current AI cycle have some resemblance to dot-com crash? And if this unexpected future were to happen, that could be a reason why markets are bidding up bank stocks, because interest could instead inch up, fattening their profitability. I'll certainly keep an open mind to this outcome, but again, I still think the risk reward is not too favorable, because if we look longer term, there would be a crash after that. Markets go in cycles. In the real world, trees don't go all the way to the sky. They would overinflate and correct. And for patient investors, there will be better periods to accumulate. Again, coming to here, if you haven't smashed the like button, encouraging you to do so. And let me round up on solutions. Let me pull back STI index. Currently, STI index is 50% into our 3 big banks, DBS, OCBC, and UOB. I did a study back 10 years ago. How did STI look like? Because it's been so flat, correct? Everybody's given up on it. I realized that back then, DBS, UOB, and OCBC only constituted 30%. Singtel was 10%, but right now it's only at 6%. The rest of the other 6 top 10 names have changed so drastically. And I realized something, they all own real estate in one form or another. Real estate has been whacked down, and that's why also these 6 companies have not delivered and helped the index grow. Particularly Singtel, they've under-delivered in a lot of ways. And I also found something, UOB used to be the second biggest bank at 9.55% allocation, correct? But right now you'll see UOB has slipped quite far beyond DBS and even OCBC. I always thought all 3 banks were going roughly the same pace, but right now it's quite clear to me that on a 10-year horizon, UOB has lagged. So how should we invest? Maybe let me throw you a first suggestion. Instead of investing in STI, then we need to get into Singapore equities via some funds that give you alternatives. This is one example, which has C Limited and Grab inside it. Something with a bigger mandate, because these 2 are fantastic tech platforms. Another solution, if you want to be a dividend investor, would be to broaden the search for dividend stocks beyond blue chip companies, to look into small cap names. And looking back at history, there are 3 that have outperformed even DBS. And let me share them with you. Over here, you'll see that iFast is one name that's grown by 558% over the last 10 years. There are some who feel iFast is inflated in share price. I own them myself right now, and I'm pretty positive about their outlook. Currently, they don't pay too much in terms of dividends because they're growing the company. Then also, Sheng Siong can be considered. They have also outperformed on a very long time scale. Sheng Siong, as we know, is recession proof because everybody needs to eat. Sheng Siong is also pandemic proof. Could they be a valuable part of a portfolio? Then next is Propnex. Singapore's biggest real estate agency. Recently, there's been a leg up in terms of their share price, and I've covered them in this previous episode. Check it out because PropNex is something I own right now, and it's a story that I think might intrigue you further if you are a dividend investor. Thank you so much for watching right to the end, and I'll see you there too. Take care as always. Goodbye.